I'm here with Miriam Sjoblom, a bond fund analyst at Morningstar, and we're going to talk about all this money that is just pouring into bonds while money is actually leaving stocks, and that's always a scary thing. And you had an interesting article from Morningstar in which you identified two particular concerns that you have about the bond fund market, or really investing in bonds in general. And unfortunately, as an investor, you can't deal with both problems at once. Can you explain that?
Sure. Well, just the number one most important thing for all the investors, rushing into bond funds to know right now is that just to set your expectations a bit lower than you had them in the last decade. Over the past almost 3 decades now, yields across bond sectors have been slowly, steadily dropping. So that has given you some price appreciation bump that shows up in your bond fund returns. Nowadays, yields are at a much lower level, so you have to expect a lower return going forward.
And mathematically, they can't go much lower, right?
That's right.
So what are the two potential landmines that bond fund investors face?
Well, we're seeing a lot of disagreement between bond fund managers, and it falls along these two lines. On the one hand, after you had this huge rally for non-government bond sectors like corporate bonds, high-yield corporate bonds, non-agency mortgage bonds, now you're seeing there's no obvious bet to make going forward. So some managers are very concerned after this rally for riskier assets that risk is a little bit expensively priced, and they're concerned about the health of the economy. You've got the concerns over in Europe. We're roiling markets in recent months. So they think now's the time to pull back those bets and be a bit more conservative on the one hand.
And when you do that, you're going to get a lower yield.
That's right.
And what's the other danger?
Well, the other danger is the risk of rising interest rates. And some managers say the best way to combat rising interest rates is to add a little more yield into your portfolio. So you can do that by owning more high yield bonds. Some non-agency mortgage sectors are areas that managers like, and owning very little in U.S. Treasuries, which are very low yielding right now.
But of course, if you do that, you end up taking a little bit more risk, and should the economy go downhill again, you're going to get burned.
That's right.
It's a catch-22. Thanks very much, Miriam.
Thank you.
And thank you for watching.